Silver has always been seen as a safe investment. People buy it, store it, and expect that when the time comes, they can sell it back easily. But over the past year, that simple idea was put to the test. It started in the middle of 2025. Silver was trading around $33 an ounce. That price seemed normal at the time. Nobody expected what was coming next. By January of 2026, everything changed. Silver's price began climbing fast, very fast. In just 1 month, the price jumped by more than $45 an ounce. At one point, during trading hours, silver touched $120 an ounce. It was one of the sharpest price increases the metal had ever seen. For many silver owners, this felt like a dream come true. People who had bought silver years earlier at much lower prices suddenly saw a huge profit sitting in their hands. Someone who bought silver at $30 an ounce could now sell it for nearly 4 times that amount. It is easy to understand why so many people wanted to cash in, and that is exactly what happened. Thousands of silver owners rushed to sell at the same time. They walked into local coin shops. They contacted dealers online. They wanted their profits, and they wanted them immediately. But here is the problem. Dealers were not prepared for this kind of rush. A normal shop can only buy so much silver in a single day. They have limited cash on hand. They have limited storage space. And most importantly, they need buyers on the other end who are willing to purchase that silver from them. When too many sellers show up at once and not enough buyers are ready to take that silver off their hands, dealers get stuck. They end up holding large amounts of silver with prices moving up and down rapidly and no clear way to move it forward. That is a risky position for any small business. So dealers began to protect themselves the only way they could. They stopped buying. It started with a specific type of silver called 90% silver. These are older coins, mostly used in everyday life decades ago, that contain 90% pure silver content. Many dealers stopped accepting this type first, since it takes more time and effort to process and resell. But it did not stop there. As the flood of silver continued, some dealers stopped buying nearly everything. Some large, well-known dealers, the kind with big storefronts and years of trusted reputation, posted signs saying they would not buy silver products at all, except for a few select items like jewelry. For everyday people trying to sell their silver, this was frustrating and confusing. They had done everything right. They saved their silver for years, just like financial experts often recommend. But when the moment came to cash in, many found themselves turned away again and again. Social media and online forums filled up with similar stories. People asking where they could sell, people asking why nobody wanted to buy. It became clear this was not just one shop having a bad day. This was happening across the country all at once. Then, just as quickly as it climbed, silver's price came crashing back down. In a single day, it dropped by more than $30 an ounce. The wild ride left many silver owners with a hard lesson. Owning a valuable asset means very little if there is no reliable way to sell it when you need to. This chain of events raised a serious question that is still being asked today. Was this a one-time event, or could the same situation happen again the next time silver's price makes a dramatic move? To understand why dealers reacted the way they did, it helps to look at how the silver buying system actually works behind the scenes. Most people only see the shop counter. They do not see everything that happens after they walk out the door. When someone sells silver to a local dealer, the dealer rarely keeps all of it sitting in a back room forever. Instead, dealers usually pass extra inventory along to larger companies called refiners and wholesalers. These bigger companies process the silver, melt it down when needed, and prepare it for resale across the wider market. This system works well most of the time. Silver moves from the public to the shop to the refiner and back out into the market again in a steady cycle. But that cycle depends on one important thing. It depends on refiners and wholesalers being able to keep up with the pace of incoming silver. During the price surge of early 2026, that pace became impossible to manage. So much silver poured into shops from everyday sellers that local dealers could not process it fast enough. They tried sending it forward to refiners, the way they normally would. But refiners were overwhelmed too. Normally, when a shop sends silver to a refiner, the refiner locks in a price right away. That locked-in price protects both sides from sudden changes in the market. It gives the shop a guaranteed number they can rely on. But during this period, many refiners stopped locking in prices immediately. Some told dealers they would need to wait 3 to 4 weeks before a price could even be confirmed. 3 to 4 weeks may not sound like a long time, but in a market moving as fast as silver was at that point, it was a serious risk. Prices could rise or fall by large amounts in just a few days, let alone a month. Dealers who sent silver forward without a locked price had no way of knowing what they would actually be paid once it arrived. This left small shop owners in a difficult position. If they kept buying silver from customers, they might end up holding inventory that could lose significant value before they could resell it. If they stopped buying altogether, they avoided that risk, but disappointed the very customers who trusted them. Faced with that choice, a large number of dealers chose caution. They paused purchases, first on harder-to-process items like 90% silver and eventually across broader categories as the backlog grew worse. Some dealers spoke about this shift only briefly through public statements, business signage, or short posts explaining reduced buying activity. Few outlined the full scope of what was happening behind the scenes, but the pattern was consistent nationwide. Independent shops, larger regional dealers, and online sellers all described similar struggles. Too much incoming silver, not enough certainty about where it would go next. As of today, the market has calmed considerably compared to the peak of the surge. Prices have pulled back from their historic highs, and much of the backlog that built up during the rush has been worked through. Many dealers have resumed regular buying practices. However, the earlier bottlenecks have not been forgotten. Some shops have adjusted their policies, setting daily purchase limits or requiring appointments for larger transactions as a way to prevent the same overwhelm from happening again. This current setup reveals an important truth about owning silver and precious metals in general. The value on paper is only part of the picture. The ability to actually convert that value into cash smoothly and reliably depends on a support system working properly behind the scenes. When that system gets overloaded, even genuine, verified silver can become difficult to sell, no matter how much it may be worth on a price chart. When dealers across the country stopped buying silver, the effects reached far beyond a few frustrated shop visits. This event touched everyday savers, small business owners, and even the broader reputation of silver as a trustworthy investment. For ordinary people, the most immediate consequence was financial uncertainty. Many silver owners had planned to sell during the price surge, hoping to use that money for retirement expenses, home repairs, or simply to lock in gains after years of holding on to their metal. When dealers refused to buy, those plans were put on hold. Some sellers had to wait weeks. Others turned to online marketplaces or shipped their silver to distant buyers, adding extra cost, delay, and risk to a process that should have been simple. This created a noticeable trust gap. Many people had always believed that silver, unlike some other investments, could be sold almost anywhere, at almost any time. That belief was central to why many families chose to save in silver in the first place. Watching that assumption fail, even temporarily, left a lasting impression on how some savers now think about liquidity, meaning how quickly and easily an asset can be turned into cash. Small, independent dealers felt their own set of pressures. Many of these businesses operate on tight margins and limited cash reserves. When the market flooded with sellers, some shop owners faced a difficult choice between financial safety and customer loyalty. Choosing to pause purchases protected their business from sudden losses, but it also risked damaging relationships built over many years with regular customers. Several dealers later noted that this was one of the hardest business decisions they had faced, since it meant turning away people they had known for a long time. On a broader economic level, this situation highlighted a structural weak point in the precious metals supply chain. The system depends on a steady, manageable flow of silver moving from the public to shops, then to refiners, and back into the wider market. When that flow suddenly speeds up far beyond normal levels, the entire chain can strain under the pressure. This is not unique to silver. Similar bottlenecks have appeared in other markets during periods of rapid, unexpected demand, showing how quickly a well-functioning system can become overwhelmed when conditions shift too fast. There are also different perspectives worth considering. Some industry voices argue that dealers acted responsibly by pausing purchases, protecting their businesses, and indirectly their customers from deeper financial harm. A shop that collapses financially cannot serve anyone in the future. From this view, the temporary buying freeze was a necessary, if uncomfortable, safety measure. Others take a more critical view, arguing that everyday silver owners were left without clear communication or support during a confusing and stressful time. They point out that many sellers had no advance warning that dealers might stop buying, and few resources to guide them through the situation once it happened. From this perspective, the event revealed a gap in transparency between the precious metals industry and the individual savers who rely on it. Both perspectives raise fair points, and neither fully replaces the other. Dealers do need to manage financial risk carefully to remain in business long term. At the same time, individual silver owners deserve clear, timely information so they can make informed decisions about their own savings. Beyond the immediate financial impact, this event also sparked wider conversations about how prepared everyday investors are for sudden market volatility in silver and in other assets. It served as a reminder that fast, dramatic price increases, while exciting, often come with hidden risks that are not obvious until the moment someone actually tries to sell. So, where does this leave silver owners today? That is a question worth sitting with for a moment. If silver prices rise sharply again, will dealers respond the same way? It is a fair question to ask. Many shops have since put new systems in place, including daily purchase limits and appointment-based selling for larger amounts. These changes suggest the industry has learned something from the experience. But whether these measures are enough to handle another sudden surge remains uncertain, and that uncertainty is worth keeping in mind. Viewers who currently own silver, or who are considering buying it, might want to ask themselves a few honest questions. How quickly would they actually need to sell if prices spiked again? Do they have more than one option for selling, rather than relying on a single local shop? Have they researched how their preferred dealer handled the last surge and what policies are currently in place? These are not questions with universal answers. Each person's financial situation and goals are different, but asking them now, during a calmer market, is far easier than trying to figure out the answers during another chaotic price swing. Looking ahead, there are a few developments worth watching. Industry groups and dealer associations may introduce clearer guidelines for handling extreme demand periods, aiming to protect both businesses and everyday sellers. Some analysts are also watching whether refiners will adjust their pricing and processing systems to avoid the kind of backlog that caused so much frustration during the last surge. Any changes in these areas could shape how smoothly the next price swing, if one happens, actually unfolds. There is no way to predict with certainty whether silver will see another dramatic price increase or when that might happen. Precious metals markets are influenced by many factors, including global economic conditions, industrial demand, and investor behavior, all of which can shift in ways that are difficult to forecast. What history does show is that sudden sharp price movements tend to create the same kind of strain seen during this recent period, regardless of the exact numbers involved. For that reason, staying informed matters. Viewers are encouraged to follow trusted, verified sources when tracking silver prices and dealer activity, rather than relying on rumors or secondhand information. Checking directly with dealers about their current buying policies before assuming availability can also help avoid unnecessary frustration. And for those holding silver as part of a long-term savings plan, keeping realistic expectations about selling timelines, especially during periods of high volatility, can make the experience far less stressful if history does repeat itself. This story is a reminder that owning something valuable is only half of the equation. Being able to convert that value into usable funds smoothly and reliably is just as important. The recent silver surge and the buying freeze that followed offered a real-world lesson in that truth, one that many silver owners will likely remember for years to come. As markets continue to shift and change, Golden Crest Finance will keep bringing viewers clear, dependable coverage of the stories that matter most to their financial future. Whether it is silver, gold, or other corners of the financial world, staying informed is one of the simplest ways to stay prepared. Thank you for spending this time with Golden Crest Finance. If this story added value to your understanding, consider subscribing, so future updates reach you as soon as they are available. Until next time, stay informed, stay prepared, and take care.